Don't need to tell you, we know it's been a bad month already for the markets. The S&P 500 down almost 4%, but we do want to take a closer look at what else the numbers may be telling us. Joining us to do that is Ann Bartels. She's head of U.S. technical analysis for Bank of America-Merrill Lynch. So great to have you here.
Great to be here. Thanks for having me.
Let's talk about the S&P 500 because we see it kind of taking out some key levels or breaking some of the trend lines. How significant is that?
From a short-term basis, it is significant. It means that we're still in the corrective phase. Taking out 1270 on the S&P is now pointing to a test of 1220 to 1170, but we peaked at 1344.
And here's the chart.
Here we go. There's the chart. So we're starting to break key support at 1270. Some people in the market were even looking at 1250.
Right.
But so now we have a confirmed break. Today we did have expansion of volume again.
We had a lot of volume in the last couple of days.
Hang on a second. For those of us who are not technical analysts, Marianne, what are those lines? Are those lines of standard deviation?
Guys, bring up the chart again. Let's bring up the chart again.
Just so we know, I mean, you can't just throw colored lines on that screen and just assume that everyone knows what they mean.
We've got the yellow,
the green. Okay, the green line. We're starting to penetrate and go through the green line. That means we have a top or supply, and that means those people are likely to sell. That's kind of how we look at it.
Right.
So in looking at that supply, we try to measure, well, how much downside can we have? Where can the buyers start coming in the support? And the support is the yellow line. And we think you'll start seeing buyers around 1220. But the risk is that you still have to maybe test even 1170. So it's very hard to put an exact number, but you can put a range where we think buyers will start coming back in the market.
Marianne, we talked so closely to talk so much today about how closely the market was tracking the news flows, particularly out of Japan, in terms of what was going on there. I mean, how does that kind of complicate when you go to look at the charts and when levels are taken out? I mean, how do you take that into account?
You always have noise in an up market and a down market. Particularly in a down market, there's always going to be negative news flow. And unfortunately, we've had a lot of negative news flow for a long time. We still have the Middle East going on, but right now, unfortunately, the events in Japan are at the forefront. Japan is a unique situation. We don't face events like this every day, so this is why we go back to the technicals to kind of figure out, are we in still a bull market or are we entering a bear market? The technicals would tell us that we're not entering a bear market. Now, obviously, you can get very sharp declines, but we don't think that this is going to be a sustainable decline. We think eventually events will hopefully pass through and that buyers will start coming back into the market. What I like about it, even though I'm a technician, is the valuation on the market is not expensive.
Right.
And I think that's another added bonus. The technicals are still generally positive longer term with good valuation. So that should suggest that buyers will eventually start coming back into the market.
Let's take a look at the tech stocks here, and you can tell us if there's any difference because obviously it's an important industry for Japan. What do you see with this slew of colored lines?
Well, I can't see those top lines, but those top little lines that have been broken to the downside basically say the same thing that we just saw on the S&P.
But we're hitting the first support there.
We did hit first support today around 2200. But given how the market traded today in the close, I'm not convinced that that's going to hold. So the next level that we would look at is close to 2050.
We do see some fight. We saw this in the market yesterday. We hit the low. We came off the low. Even today, we've come off the low. Then we started to move down a little bit again. So there is some fight in the market.
There's a lot of fight in the market, and I would suggest if we could get positive news out of Japan, this market would have a violent rally to the upside.
Japan certainly had a violent rally to the upside.
Exactly. So, but as long as the flow of news stays negative, the likelihood is that investors will take risk down. What I think a lot of is what happening in the market is fast money moving out. We had fast money, primarily hedge funds, fully positioned in the market with leverage. And I think, and certainly when we look at the CFTC data and look at the futures in the NASDAQ, they're very long the NASDAQ 100. So I think what you're seeing in the market is a de-risking. And to me, that's very bullish because once you finish that de-risking, you should start seeing the buyers come in.
You know, we see this the news flow staying negative on both the supply and the demand side for crude here. Obviously, in the Middle East, there continue to be concerns, but you won't need as much after the catastrophe in Japan. What do you see on the crude chart? Because it's been an interesting trade recently.
We like crude, and our target on crude is 118 to 120.
Wow.
That is a very bullish pattern for crude. But when you look at the commodity complex, many of the other complexes have already rallied this year. The energy complex, particularly crude, up until recently had not. So now you're starting to see crude participate. So I think it's part of the bull market in commodities. And you do have a bid in the market because of what's happening in the Middle East. So our sense is eventually you're going to see crude back up around that 118, 120 level.
You definitely had a bid in the market for Treasuries today, particularly in that 10-year. Let's talk a little bit about what we're seeing in the 10-year. And we're going to bring up a chart that actually shows the 10-year yields. Where do you see this going?
3%. So this again is confirming that we're in a de-risking, a defensive trade. Again, we're breaking key support levels, pointing to yields coming down. We think they're going to target around the 3%. Also, you see the green line, the uptrend line has been broken. Then we have further confirmation of that kind of first yellow line being broken. So you're seeing the market move defensively as we see the equity markets pull back. And we do think this will be tactical. We don't think that this is a strategic trade, a longer-term trade.
When you look at the chart, just got a few seconds left, is it a market that makes you feel a little uncomfortable here?
No, I don't feel uncomfortable. I mean, we've been looking for reasons to buy the market. Many people, particularly retail, have been in the sidelines looking for a pullback. And we haven't seen anything, at least yet, that would suggest that we're going to have anything that would suggest a bear market style movement. So we're looking for anything between 10, 13%, could even be 15%, which is a normal correction, which we haven't had since the middle part of last year. Last year, I'd remind our viewers, your viewers, we had a 17% correction in the market from the peak of April to the low of July. This is very typical market action. Unfortunately, investors feel uncomfortable when they look at the news flow on top of that.
It's hard not to be, right? Okay. Marianne, thank you, as always. Nice to have you here. Ann Bartels.